It is officially over. For years, we've sat here doing the same ritual, speculating, arguing, staring at charts, tracking open interest, and trying to guess when the whole thing would finally snap. We kept saying that one day the banks would break. One day the naked shorts would get caught so badly that the entire financial system would be forced to bend the knee. We kept warning that the bullion banks were leveraged to the hilt, playing a reckless game of fractional reserve paper trading against a physical asset that was running out. Until this morning, that was just a theory. Yes, a mathematical probability, but still a theory. We didn't have the smoking gun. We didn't have the body. Well, stop guessing. Stop speculating, because that day is today. The body has been found. Ladies and gentlemen, Asian guy here, while you were glued to your screens watching the spot price of silver hit $77. 16, while you were cheering the breakout and calculating your net worth, something far more important, something darker, something far more terrifying was happening deep in the plumbing of the global financial system. Something the mainstream media is terrified to report because it proves beyond any doubt that the banking system is insolvent. We just received the official data tied to the Federal Reserve Bank of New York's overnight operations, the overnight reverse repurchase agreements, repo facility numbers for this morning, Friday, December 26th, and the number that flashed across the terminal is not a typo. It is not an error. It is a confession. $17,251,000,000. In a single morning, in the quiet hours right after the Christmas holiday, the too big to fail banks tapped the Federal Reserve's emergency liquidity window for more than $17 billion in cash. You have to understand what that means. You have to understand what the repo market actually is. This is not the window where healthy banks casually go to borrow in order to expand a business line. It's not where you go for growth capital or to fund a shiny new project. The repo window, when it's being used like this, is the pawn shop of last resort. It's the emergency room when the patient is having a heart attack. If you are a healthy bank with a balanced book, you don't touch the Fed's emergency window. You fund yourself in the interbank market. You borrow from peers. In banking culture, avoiding the Fed's window is a badge of honor because going there screams weakness. It's the walk of shame of the financial world. So why would the masters of the universe, the institutions that are supposed to run the global economy, need $17.251 billion in cash at 8 a.m. on the day after Christmas? Payroll? No. Operating expenses? No, they needed it because they were bleeding out. They needed it because they just got slapped with the biggest margin call in the history of the commodities markets. Connect the dots and look at the timing. It's impeccable. Yesterday, silver gapped up. Overnight, it didn't crawl. It teleported to $77. The banks are sitting on short positions, measured in the hundreds of millions of ounces. They sold those contracts at $30. They sold them at $50. They sold them at $70, convinced they could tamp it down the way they always do. They assumed they could scare retail investors, trigger stop losses, and buy it back cheaper. But retail didn't sell. Chinese industrial buyers didn't sell. The vaults were empty, and the price didn't go down. It went vertical. Right now, silver is trading at $77.16. Now, do the math. Every single $1 increase in silver creates billions in losses on their books. But there's a critical difference between losses you can pretend are unrealized and a margin call you must pay in cash. For months, they've hidden the damage. They mark it unrealized. They tell themselves the price will come back down so they don't have to admit the hole in their balance sheet. They kick the can, they stall, they delay. But the COMEX clearinghouse doesn't care about accounting theater. The exchange doesn't care that you believe the price will fall next week. The exchange cares about solvency right now. When price moves $5 against you in 24 hours, the clearing system spits out a number and says, "You're underwater. Post the cash to cover the risk, or we liquidate you." This morning, the machine spat out a number, and that number was evidently $17.251 billion. The clearinghouse called the banks and said, "Pay up." The banks looked at their ledgers, looked at their liquid cash reserves, and faced the terrifying truth: they didn't have it. They were illiquid. They were insolvent on a mark-to-market basis. So they did what a drowning institution does when it has no choice. They grabbed their U.S. Treasury bonds, the last real collateral they have left, and ran to the Federal Reserve. They pawned those treasuries for overnight cash just to keep the lights on, just to stop the clearinghouse from forcibly closing their short positions and launching silver to $200 in an instant. That $17.251 billion wasn't a stimulus check. It was a tourniquet, a desperate attempt to stop the bleeding before the patient dies on the table. And look at the calendar. It's Friday. In banking, bad news is buried on Fridays. Banks fail on Fridays. Regulators seize assets on Fridays. And the fact that this liquidity spike hit on the Friday after Christmas, when nobody was supposed to be watching, tells you everything about the severity of the crisis. They were praying it would slip under the radar. They were hoping holiday volume would be low enough that no one would notice the Fed effectively conjuring $17 billion to rescue a silver short. But we noticed. We are watching. And what we are seeing is the suppression machine breaking down. For decades, the playbook was simple. The banks sell paper silver to push the price down. If the price rises, they sell more paper. They have infinite paper, so they can always win. But there's one thing that kills that scheme: a liquidity crisis. If you run out of cash to post margin for your new shorts, you can't keep selling. You lose your ammunition. That $17.251 billion represents the bottom of the barrel. The moment they ran out of their own money and had to start using taxpayer-backed money routed through the Fed to keep fighting the market. That changes the entire dynamic. We're no longer fighting JP Morgan or Citi. We're now fighting the Federal Reserve directly. The Fed has stepped in as the counterparty. They are effectively subsidizing the short position. But here's the catch. Even the Fed can't print physical silver. They can print dollars to keep banks breathing, but they cannot print the metal that has to be delivered into the real market, especially not into the Chinese industrial demand machine. And worse, this solution makes the problem more dangerous. The banks needed cash because the dollar was losing value against silver. The Fed's answer, print more dollars, injects $17.251 billion new dollars into the system. What does that do? It devalues the dollar further. It throws gasoline on inflation. It validates the exact thesis, pushing silver higher. It's a self-defeating feedback loop. The more they bail out the shorts, the higher the price goes. The higher the price goes, the bigger the bailout must be. We are watching the beginning of a hyperinflationary melt-up localized in the commodities market. The banking system has trapped itself. They can't allow silver to rise, or they go bankrupt. But they can't stop silver from rising without printing money. And printing money makes silver rise faster. This $17.251 billion is just the first tranche. It's the tip of the iceberg. If silver goes to $80, something that could happen before the market closes today, then $17 billion won't be enough. They'll need $20 billion, then $30 billion. You're going to see the repo market explode the way it did in September 2019, right before the global financial system seized up. Remember September 2019? Repo rates spiked, the Fed panicked, and months later, liquidity flooded the world. The pattern is repeating. But this time, the trigger isn't some vague interbank lending freeze. This time, the trigger is specific. The trigger is silver. The trigger is a hard asset rebellion against paper promises. The skeptics will smirk and say, $17 billion is nothing compared to the global economy. Wrong. In the leverage-soaked world of futures, $17 billion of margin can represent hundreds of billions in notional exposure. That's not a small leak. That's the hull of the Titanic ripping open. That's a systemic failure territory. And notice who tapped the facility. The data is anonymized, but we know the type of players it has to be. It wasn't regional banks. Small banks aren't sitting on massive short positions in silver futures. This is the GSIBs, global systemically important banks The whales, the same institutions that told you silver was a pet rock, now pawning the family silver, well, the family treasuries, to survive the pet rock's revenge. This is vindication for every stacker, every silver bug, every person who held physical metal through years of ridicule. You were right. You broke them. You held the line while they levered themselves into oblivion. Now, the bill is due, and $17.251 billion is the receipt. It's the proof they are terrified. And do not let anyone gaslight you into calling this normal year-end maneuvering. Yes, year-end window dressing happens, but it happens in open markets. It doesn't happen through an emergency Fed window for $17.251 billion on a day when silver is ripping 5%. The correlation is 1.0. This is a margin call, period. So what happens next? If they needed $17.251 billion at $77, what happens at $85? What happens at $100? The Fed can't keep this hidden forever. As those repo numbers climb, confidence in the banking system will erode. We are staring at a potential banking crisis that starts not with bad mortgages, not with tech stocks, but with a short squeeze in monetary metals. We are past correction. We are in systemic rescue. The Fed is now actively managing the silver price, not by selling metal, but by keeping the shorts on life support. But a patient on life support can't fight a war. The banks are incapacitated, zombie institutions now, alive only because of the Fed's drip feed. And zombies cannot stop a bull market. They can only watch it. Suppression is effectively over because the suppressors are bankrupt. They're out of ammo. All they have left is the Fed's credit card, and they just maxed out the first limit. That $17.251 billion lifeline proves the supposedly unlimited supply of paper has slammed into a hard wall. That wall is liquidity. You can print infinite contracts, but you cannot print infinite margin cash without destroying the currency. They hit the limit of leverage. The game is mathematically over. And don't let sterile phrases like repo and liquidity operations bore you. You need to feel the raw mathematics of what's happening. This is leverage, the kind of leverage that turns a small mistake into a nuclear detonation. Remember how COMEX works? One single silver futures contract represents 5,000 ounces of silver. When a bank sells that contract, it promises to deliver 5,000 ounces. But it only posts a small fraction of the value in cash, usually 10% to 15%. That's margin. That tiny down payment lets them control enormous quantities of silver with very little money. It's the secret to their power. It's how they suppressed price for 40 years by selling paper promises they could never fulfill. But leverage cuts both ways. Let's do the conservative hypothetical for a too-big-to-fail bank. Say it's short just 10,000 contracts, tiny in bullion bank terms. 10,000 contracts times 5,000 ounces is 50 million ounces of silver. If silver rises by $1, that bank loses $50 million. $1 move, 50 million gone. Now look at what happened in the last 24 hours. Silver didn't move $1. It moved $5. It gapped from $72 to $77. That means that single bank on that single position lost $250 million before finishing its morning coffee. And that's just one bank. Aggregate the commercial short position, the 4 big U.S. banks plus the 4 big international banks, and you're talking hundreds of millions of ounces. You're talking billions in losses piling up in real time. Here's the trap. The unrealized trap. Bank CEOs go on CNBC and shrug, "These are just paper losses. We haven't closed. Price will come back down." They treat the market like a casino where they can wait for the roulette wheel to spin their way again. But the clearinghouse is the pit boss, and the pit boss doesn't care about your long-term story. The pit boss cares about the chips on the table right now. That is mark-to-market accounting. Every night, the exchange recalculates the value of every position. If price moves against you, they don't wait for you to close. They reach into your account and take the cash to cover the difference. So when silver hit $77 this morning, it wasn't merely a rough day, it was a liquidation event. The $77 level is critical because it's the mathematical point of no return for their risk models. At $77, losses blow past the cash buffers kept for daily operations. Their internal value at risk models detonated. Red lights flashed in risk offices. That's why they needed the $17.251 billion, not to grow, not to invest, but to stay in the game, to keep the clearinghouse from seizing assets. We are witnessing technical insolvency. If these banks had to liquidate their entire short today, if they had to buy back every ounce owed at $77, they would be bankrupt. Equity wiped out. Zombies with a pulse supplied by the Federal Reserve, pretending to be masters of the universe. But here's what math does. It stays cold, it doesn't bend, and it doesn't care about the Fed. That $17.251 billion buys time, another day. It doesn't solve the real problem, because the real problem isn't cash. Cash can be printed. The Fed can print $17 trillion if it wants. The problem is metal. The clearinghouse demands cash for margin, yes, but the other side of the trade, the contract holder, the buyer, is no longer satisfied with a cash check. They saw Venezuela, they saw the Shanghai price. They don't want settlement. They want the 5,000 ounces. And that's where the mathematics of insolvency turns into the physics of impossibility, because while the Fed can wire billions in a nanosecond, it cannot print 63 million ounces of silver. And that is exactly what the market is demanding. We have crossed from a financial crisis into a delivery crisis. And the numbers coming out of the COMEX delivery reports are staggering. This morning, the CME Group released the daily delivery notice report for December. Normally, December is quiet. Traders roll contracts to March or settle for cash. But this December is different. This December is a run on the bank. We are seeing a total of 1,277 delivery notices issued for the month. To a layman, that sounds like a random statistic. Let me translate. One contract is 5,000 ounces. 1,277 contracts is 63,535,000 ounces of silver. Let that sink in. Over 63 million ounces of physical metal standing for delivery in New York right now, roughly 8% of the entire annual global mining supply demanded in a single month from a single exchange during a holiday week. In a normal market, this number is a fraction of that. Usually open interest collapses into expiration because nobody wants 5,000 ounces dumped on their driveway. Hedge funds trade paper for profit, not for pallets of metal, but behavior has changed. The longs aren't rolling. They're holding to expiration and demanding the warrant. This is the industrial panic we warned about. The entities behind these contracts aren't speculators. They're supply chain managers, battery manufacturers, sovereign wealth funds. They look at deficits. They look at the Venezuela blockade and they say, I don't want your cash. Your cash is melting. I want the metal. And that's where panic hits the banks because they don't have it. Look at the registered category in the COMEX vaults, the metal actually available for delivery against contracts, and it's been bleeding dry for months. We tracked the Asahi drain. We tracked the JP Morgan drain. Registered inventories hovering near historic lows. So you have demand for 63.5 million ounces while vaults are effectively empty of unencumbered metal. So how do the banks satisfy these delivery notices? They have to go into the open market and buy it. They have to become emergency buyers in a market already printing all-time highs. Imagine being a bank short silver. You're losing money every second, and now to settle, you must buy physical at $77, $78, maybe $80, and hand it to the party that just beat you. That is buying pressure as rocket fuel, forced buying, price inelastic buying, and it gets darker. We're hearing rumors, and the data supports it, that banks are beginning to cannibalize ETFs to find metal. They're eyeing the stockpiles held by SLV and SIVR, trying to use authorized participant loopholes to drain metal and move it into COMEX to satisfy delivery. They're robbing Peter to pay Paul, but Peter is watching. ETF holders are watching. If they raid the ETFs to bail out COMEX, the ETF price can disconnect, shareholders can sue, and it becomes a legal minefield. So, yes, the Fed's $17.251 billion solves a cash problem, but it does not solve a 63.5 million ounce problem. You can't print a silver bar. You can't digitally create an industrial commodity. The only way to fix this imbalance is for price to rise high enough that people stop demanding delivery. But at $77, demand is increasing. At $80, demand likely increases even more because FOMO ignites. We're in a Giffen goods scenario. Normally, higher price reduces demand. But for a strategic asset in a shortage, higher price increases demand because people realize it's running out. Those 1277 contracts standing for delivery prove the price is not high enough to ration demand. It's too cheap. $77 is too cheap. If it were truly expensive, people would be selling. Instead, they're taking delivery of 63 million ounces. This is the break the exchange moment. If COMEX fails to deliver, if even one contract defaults, it's game over. The exchange declares force majeure, forces cash settlement, and the moment it does, physical silver in the real world decouples from paper silver. You'll see paper at $80 and physical at $150. Those 1277 notices are the countdown clock. Tick, tock. And since we're talking about robbing Peter to pay Paul, we need to address the strange anomaly in the SLV ETF today, because if you don't understand the plumbing of the paper market, you'll misread the data. You'll see headlines and assume pressure is easing when, in reality, pressure has become terminal. A Bloomberg headline crossed this afternoon that confused a lot of retail traders. The borrow fee for SLV, the cost hedge funds pay to borrow shares so they can short, dropped. It fell from over 1.5% on Tuesday down to 0.62% today. At the same time, the 10 million new SLV shares suddenly appeared as available to borrow. Mainstream financial media, the same CNBC pundits who've told you to dump silver for 3 years, jumped on it. Look, borrow fees are dropping. The squeeze is over. Liquidity is back. Shorts are comfortable. They want you to believe a lower borrow cost means the market is normalizing. That paper supply is flooding in to cool the rally. They are lying. Or if we're being charitable, they are fundamentally incompetent and don't understand what capitulation looks like. Here's what a borrow fee is. Pure supply and demand, the price of renting the stock. When everyone wants to short, demand for borrowed shares explodes and fees spike to 10%, 20% or more. We saw it with GameStop. We saw it with AMC. A high fee means the battle is raging. Shorts paying up to keep the position open. So what does it mean when the fee collapses? When borrowing becomes practically cheap in the middle of a historic rally? It means the shorts left the building. Demand for borrowing evaporated. Why? Because nobody wants to be the idiot shorting silver at $77. Hedge funds ran the numbers. They saw the $17 billion repo spike. They saw 63 million ounces standing for delivery. They saw the U.S. Navy boarding tankers in the Caribbean, and they decided shorting silver at $77 is a suicide mission. So they returned the borrowed shares. They closed positions. They covered. When they cover, shares go back to lenders, flooding the lending pool. Hence the 10 million shares available headline. And because no new shorts are stepping in to replace them, the fee crashes. That isn't bearish strength. That is bullish victory. It's the white flag. The short army has disbanded. They looked at the battlefield, saw the physical carnage, and retreated. Think about that psychological shift. For 40 years, whenever silver spiked, smart money reflexively shorted it. Confident banks would smash it back down. Silver up $2, short it. Easy money. But today, with silver up $5, borrow fees dropped. The reflex is broken. Smart money is terrified to stand in front of this freight train. They know the Fed is involved. They know shorting silver now isn't fighting a mining company. It's fighting the U.S. printing press and China's strategic demand. There's no alpha there. There is only bankruptcy. So speculators capitulated, they stepped aside, and without speculators piling onto the short side, who is left to stop price from rising? Nobody. The dampening mechanism is gone. The friction is gone. That's why we're seeing air pockets to the upside. In a normal market, as price rises, short sellers fade the move, providing liquidity and slowing ascent. Today, price jumped $5 and nobody stepped in. The sell-side liquidity vacuum is absolute. Now look again at those 10 million shares. Where did they come from? In the ETF world, shares are created and destroyed by authorized participants, big banks, based on demand. If investors sell SLV to buy physical, the ETF shrinks. The basket gets broken down. But in chaotic markets, flows get weird. One possibility, consistent with the cannibalization theory, is that authorized participants are creating new SLV shares, not backed by real metal, but by leased metal or paper credits, specifically to lend to desperate market makers hedging options exposure. Printing paper to patch a paper disaster. But even if they print shares, nobody wants to borrow them to short. That's the point. You can lead a horse to water, but you can't make him short a monetary metal during a hyperinflationary collapse. This collapse in borrow fees removes the ceiling. As long as aggressive shorts existed, you could get a classic short squeeze pop followed by a crash, but what we're entering is different, a vacuum squeeze where sellers simply vanish, a repricing event. If you hold SLV, that should validate your thesis, but it should also make you nervous about the vehicle. Shorts disappearing is good for price, but if authorized participants are playing games with share count to manage crisis liquidity, ETF tracking error can blow out. We already see SLV lag spot slightly. We see SLV lag physical coin prices massively. Smart money isn't just closing shorts, it's rotating, closing SLV shorts, flipping long into miners or physical metal. That explains the 50% move in junior miners today. Capital that used to suppress price is now chasing it. The energy reversed. So when you see SLV borrow fee drops, don't let them gaslight you into thinking the squeeze is over. The squeeze evolved. The phase where we force them to cover is shifting into the buyer's panic phase, where everyone tries to get in at once. Shorts covering drove the move to $77. They're largely out now. Losses taken, fleeing. The next leg to $100 won't be driven by shorts covering. It will be driven by fresh money, pension funds, sovereign wealth funds, retail waking up and realizing the bank surrendered. That retreat removes the last line of defense for fiat currency. As long as speculators shorted silver, they were effectively defending the dollar, betting the dollar would hold value against metal. By walking away, they're admitting the dollar is undefendable. They're admitting the Fed's $17.251 billion injection is inflationary, and they refuse to be on the wrong side of it. This clears the runway and leaves the market to physical fundamentals, and the fundamentals are catastrophic for consumers and ecstatic for investors. Demand is vertical, supply is zero. Now we have to talk contagion. If shorts capitulated, banks tapped the repo window, and physical delivery is breaking, this doesn't stay inside silver. Silver is the canary in the coal mine, but the gas is already filling the room. Why did the Fed step in so fast with $17.251 billion? To save a few trading desks? No. They stepped in because they know history. In 1980, the silver crisis threatened brokerage houses. In 2008, commodity collapse triggered margin calls that exposed the subprime rot. The financial system is a daisy chain of leverage. If one major bullion bank fails a margin call in silver, it defaults to the clearinghouse. If it defaults, the clearinghouse hits the default fund, capitalized by other banks. If the hole is big enough, and at $77 silver, the hole is a crater, contagion spreads instantly. JP Morgan is counterparty to Citi. Citi is counterparty to HSBC. One domino falls, they all fall. The Fed knows this. They saw internal risk reports. They saw that a failure on a metals desk could trigger cross defaults in interest rate swaps and currency derivatives. Silver is the small cog that turns the big wheel. If the cog shatters, the machine stops. So the Fed faced a binary choice this morning. Choice A: let the free market work. Let banks that made bad bets fail. Let silver find true equilibrium, even if it bankrupts too big to fail. Choice B: print money, bail them out, and destroy currency credibility to preserve the banking structure. They chose B. They always choose B. But there's a consequence. Printing $17.251 billion to suppress a crisis caused by inflation and debasement guarantees more inflation and more debasement. They're trying to extinguish a fire with gasoline. This injection is the signal we are back to QE infinity. They may call it temporary liquidity operations, but we know what it is: money printing, and the market knows too. That's why junior miners are up 50%. Equity markets sniffed the pivot. The Fed has effectively said, we will not allow banks to fail because of a commodity squeeze. And the only way to keep that promise is unlimited printing. That means the Fed put the safety net under stocks has shifted under silver. If silver dips, banks face trouble again and Fed prints more. If silver rips, banks face trouble and Fed prints more. All roads lead to the printing press. That removes downside risk for silver investors. The worst case isn't a crash, it's a bailout, and bailouts are bullish for hard assets. So capitulation in SLV shorts and Fed repo intervention are two sides of the same coin. Both admit the system can't handle fair prices. Shorts fled because the game is broken. The Fed stepped in because the game was about to end. And by stepping in, they sealed the dollar's fate, confirming to China, Russia, BRICS, the world, that the U.S. banking system is fragile and the dollar is being diluted to keep it alive. That accelerates the move away from the dollar. It validates blockade narratives. It validates the war metal thesis. We are watching the old financial order die in real time. The borrow fee dropping is the sound of rats jumping ship. The repo spike is the captain trying to bail water. But the hull is breached. The 63 million ounces of physical demand is the iceberg, and we already hit it. Now comes the final realization. If the Fed is back in, shorts are gone, and delivery demands are record-breaking, then the targets we talked about, $80, $100, are now backed by the full faith and credit of the Fed's printing press. This isn't only a supply shortage anymore, it's a monetary devaluation event. The pivot arrived, not with a press conference or fancy speech, but with a desperate $17.251 billion wire transfer on the Friday after Christmas. The gates are open. The dollar is being sacrificed. Silver is the chosen vessel for the wealth transfer that is about to happen. The $100 roadmap is no longer speculation. It's policy certainty because the alternative is systemic collapse. And today the Fed proved they'll pay any price to avoid that collapse. That price will be paid in the value of your fiat currency, pushing the nominal price of real things to the moon. So buckle up, the shorts are out, the Fed is in, and the rocket has a cleared launch pad. Now ask yourself, why would the Federal Reserve, arguably the most powerful economic institution on earth, care about a few billion lost on a shiny metal? Why debase its own currency and risk credibility just to save a handful of trading desks? The answer is the terrifying architecture of modern finance. We don't live in separate silos anymore. We live in daisy-chained leverage, where every asset class is wired to every other asset class through the dark magic of derivatives. Mainstream media treats silver like a niche commodity. But to banks, silver is not just a commodity. It's collateral tier. It's a foundational block in a tower of rehypothecated value. Banks didn't just sell paper once. They leased it, swapped it, bundled it, and used it as collateral to borrow money to bet on treasuries, yen, tech stocks. That's the contagion nightmare that woke Fed governors this morning. If a major bullion bank, call it Bank X, can't meet a silver margin call, it defaults to COMEX clearing. The moment it defaults, the clearinghouse has legal rights to seize collateral, treasury bonds, corporate bonds, cash. Now, imagine Bank X is also counterparty to $1 trillion in interest rate swaps with a pension fund. Suddenly, Bank X is frozen. The pension fund can't hedge. The pension fund panics and sells bonds. Bonds crash. When bonds crash, collateral values across the system collapse. Now Bank Y gets a margin call. Dominoes. It's 2008 again, but this time the toxic asset isn't subprime mortgages. It's a naked short in a strategic metal facing physical shortage. The Fed stepped in with $17.251 billion because they saw the red zone on internal monitors. They saw that failure in a GSIB's commodities division could lock up the repo market for everyone. The silver squeeze wasn't only squeezing shorts, it was squeezing liquidity for the entire U.S. banking sector. Again, binary choice. Choice A. Let markets function. Let bad risk management die. Wipe shareholders. Let silver reset to $200 overnight. Chaotic but honest. Choice B. Intervene. Print. Provide liquidity. Save banks. Destroy the signal. They chose B. They always choose B. They sacrifice dollar integrity to save bank structure. But here's the fatal flaw. The doom loop they just stepped into, printing $17.251 billion to solve a silver squeeze pours jet fuel on inflation. Consider the signal to the world. The U.S. dollar is supposed to be risk-free, but today the Fed admitted that the system behind it is so fragile, a $5 move in silver threatens solvency. Print to prevent collapse. Currency devalues. Currency devalues. Hard assets rise. Hard assets rise. Bank shorts worsen. To save them at $77, they printed $17.251 billion. That printing can push silver to $85 next week. Then they'll print $25 billion. That pushes silver to $95. It's self-defeating. They're trying to smother fire with cash, but cash is flammable. They can't stop printing or the system collapses. They can't keep printing or the currency collapses. The market knows. And the really smart money, macro allocators, sovereign wealth funds, is watching. They see the Fed put has shifted. For 20 years, it was under stocks. Stocks crash. Fed prints. Today, the Fed effectively put a floor under silver. By bailing out shorts, they capped the downside and signaled infinite liquidity to prevent blowouts. If you own silver, the U.S. central bank is effectively subsidizing your risk. If price drops, the physical shortage remains and the squeeze rebuilds. If price rips and breaks banks, the Fed prints and inflation drives price higher again. Heads you win, tails you don't lose. That's why junior miners surged 50% today. Markets are forward-looking. Powell didn't need a podium. Actions are louder. A $17.251 billion emergency repo operation is the pivot. It's QE infinity in everything but name. And think about what this means for too big to fail. By tapping the facility, bullion banks became wards of the state. Zombie utilities kept alive to keep credit flowing. That means silver suppression is no longer a private conspiracy. It's effectively state-sponsored, and history shows governments cannot successfully peg commodities forever. The London gold pool in the 1960s, Nixon price controls in the 1970s. Every time, physical reality wins. The London gold pool collapsed in 1968 when a run drained the vaults. We are watching a New York silver pool collapse in 2025 as the run drains COMEX. Same mechanism, same hubris, same outcome. Violent repricing to a level where demand finally meets supply. Contagion isn't only financial, it's psychological. Trust is the currency of banking. When a bank taps emergency liquidity, trust evaporates. Other banks lend less. Counterparties demand more margin. Financial conditions tighten worldwide. That's why the dollar index, DXY, tanked today, even though flight to safety narratives usually lift the dollar. Why did the dollar fall? Because the market realized the crisis is the dollar. The crisis is the solvency of the issuers of the dollar. Investors see U.S. debt, $38 trillion and counting. They see interest payments, $2 trillion a year. Now they see the Fed printing to bail out commodity speculators. They connect the dots. The only way out is inflating the debt away. Silver becomes the lifeboat that cannot be diluted. You can dilute dollars, you can dilute euros, you can even dilute Bitcoin with forks and endless altcoins, but you cannot dilute silver. It is atomic element number 47, forged in supernovas with a fixed amount in Earth's crust, and we already mined the easy stuff. So the contagion spreading through banks is the free market's antibodies attacking the virus of fiat currency. The system is trying to heal. The fever, high prices, is the cure. High prices stimulate supply and ration demand. The Fed is trying to suppress the fever, but the patient is too sick. Now factor the geopolitical angle. Do you think Beijing missed that repo print? Do you think Moscow didn't notice? They're watching the U.S. banking system bleed, and it validates their strategy. If your opponent is illiquid, desperate for cash, do you ease up? No. You press harder. You buy more physical. You tighten the blockade. You squeeze until they break. That $17.251 billion didn't just save a few banks. It signaled weakness to geopolitical rivals. It said the U.S. financial shield is cracked. That guarantees escalation in the war on shipping and commodities. China knows. If they keep silver above $80 for another week, they can force the Fed to print another $50 billion. Push to $90, maybe force $100 billion, forcing the U.S. to hyperinflate its own currency just to keep banks alive. Financial warfare 101. And the Fed walked into the trap. So as we reach the end, understand this. The $100 target isn't about charts or deficits anymore. It's about a regime shift. We crossed the Rubicon. The Fed is now buyer of last resort for banks' bad silver bets. And because the Fed has infinite dollars but zero silver, silver must rise to infinity in dollar terms to balance the equation. The $17.251 billion was the all-in moment. The Federal Reserve shoved its chips into the center of the table, but the market is holding the royal flush. The market holds the physical metal. The Fed holds a printing press that is rapidly losing its power to command respect. We've reached the conclusion of this report, but really we've reached the beginning of a new monetary epoch. This morning's events, repo panic, SLV short capitulation, record-breaking delivery demands, confirmed what every gold and silver investor has waited for, the pivot. For 2 years, mainstream financial media obsessed over the pivot. When will Powell cut rates? When will tightening end? They expected a ceremony, press conference, dot plot adjustment, polite words. Instead, the pivot arrived in the dark. A desperate $17.251 billion liquidity injection to save a banking system choking on leverage. That is the pivot. When the central bank must print to prevent systemic collapse caused by a commodity squeeze, tightening is mathematically finished. They cannot fight inflation and bail out banks simultaneously. They chose the banks, and by choosing the banks, they surrendered to inflation. That changes silver completely. We're not merely tracking supply and demand. We're tracking currency devaluation. The Fed put the mythic safety net under stocks is now planted under silver. Consider the implications. If silver crashes tomorrow, banks may breathe for a moment, but the physical shortage remains. The squeeze rebuilds. If silver rips higher, banks face insolvency and the Fed prints. Printing devalues the dollar, which pushes dollar-priced silver higher. The Fed has created a mechanism where its own survival reflex launches precious metals. They are trapped in a room with shrinking walls. To save the system, they must destroy the currency. As the currency is destroyed, the nominal price of real things must rise toward infinity to compensate. That's why the $100 target is no longer a speculation based on industrial use or mining deficits. It's policy certainty, the mathematical output of the equation the Fed just wrote. If they must print hundreds of billions, eventually trillions, to keep repo liquid and the derivatives complex from detonating, then silver at $100 is actually cheap. In a hyperinflationary liquidity cycle, $100 becomes the new $20. So what's the roadmap for the next few weeks? How do we navigate endgame? First, volatility will be extreme. The beast is wounded, not dead. With fresh $17.251 billion, banks may try one last desperate smash, perhaps Monday morning, trying to crash paper price into oblivion to break retail psychology. Do not let them. If paper drops $10 in a flash crash, don't panic, smile. Recognize death throes. Every paper smash just makes physical cheaper for China, India, and the investors draining vaults. A paper smash during a physical shortage is like putting a sale sign on an empty shelf. It doesn't create inventory, it accelerates panic. Second, watch the basis, the difference between futures and spot. In a healthy market, futures trade above spot, contango. In a shortage, spot trades above futures, backwardation. We're already seeing backwardation in near months. When spot rips away from futures, when dealers charge $10, $15, $20 over spot, that is the real price. The screen price is a lie. The street price is truth. Follow truth. Third, and most important, prepare for the unobtainium phase. We're close to the moment when major dealers simply run out of stock. Those 1277 delivery notices are vacuuming wholesale supply. Once wholesalers are empty, retail shelves go bare. The buy button disappears. When that happens, price becomes effectively infinity for anyone not already holding. You won't be able to get in. Doors close. We already see early signs. Delays stretching into February for certain sovereign coins. If you're sitting on cash waiting for a dip, you're playing Russian roulette with a fully loaded gun. The risk isn't buying too high. The risk is not being able to buy at all. And that leads to the final strategic conclusion. We are witnessing the greatest wealth transfer in history. Wealth isn't destroyed. It's transferred. It's transferring from holders of paper promises, bonds, currencies, derivatives, to holders of real things. For 40 years, flow went from real to financial. The financial economy cannibalized the real economy. Now the tide is turned. The real economy is devouring the financial economy. The miners, the stackers, the physical holders. You are becoming the new captains of capital. The banks are insolvent. The Fed is trapped. Vaults are empty. War is escalating. Shorts have fled. The stars aligned in a way that happens once in a century. Do not sell your position for fiat currency being printed to bail out your enemies. Hold the line. When silver hits $100, don't sell for dollars. Leverage it. Borrow against it. Trade it for land. Trade it for a business. But don't trade it back into the burning building of the fiat system. That $17, $251 billion this morning was the flare gun. It lit the night sky and revealed the battlefield, a banking system in full retreat. They abandoned the fortress of sound money. They're burning furniture to stay warm. You have the metal, you have the position, you have the patience. The game is rigged, yes, but for the first time it's rigged in your favor. The Fed guaranteed your upside by guaranteeing the inflation needed to save the banks. The ghost week is ending. Reality is beginning. The $100 wave is unstoppable, and you are riding it.